Welcome back. Shares of Raymond James are fractionally lower today, despite reporting a beat after the bell. They said robust investment banking activity helped lift revenue to a record of about $3.5 billion in the quarter, but are expecting a drop in fees and net interest income next quarter. Management flagging some seasonal headwinds. Joining me now exclusively is management. Paul Reilly is CEO of Raymond James, and this is his swan song, his last earnings report. He is stepping down next month. Paul, it's great to see you, and I don't know, do I say congratulations?
Well, a little bit of all. We got a great succession in place, and we've had a great quarter. A little harder after the tragic, thinking about the family and that tragic crash yesterday.
Yeah.
But great coverage. We had a very, very strong quarter. And one of the goals, I used to kid saying that Tom James, Dad, founded the firm. Tom ran it for a long time. And when I came in, I said my job was to be the third dead guy on a long hallway of dead people, to have a successor and have it as an independent firm. And so any, reticence I have about giving up the job after 15 years, I feel so great about Paul Schuker and the team taking over that it's really, I reached my mission here at the firm, and I know it'll continue in great hands.
I won't say it, but we haven't had a lot of turnover at some of the bigger banks. And this, I will just leave that. I'm not gonna admit. So I take your point. I'm very curious. I think a lot of our viewers are, a lot of investors are as well. I mean, what can you tell us about the deal-making pipeline? We have a new administration, which seems more open to deals, although I think they just blocked one today. I have to go back and look into the details of that one. You guys do a lot of bank advice. Last year was actually a busy year, for some of the deals. So what do you see coming down the pipeline?
We saw, after records, a few years ago for the whole industry, M&A got very slow. And I think part of it was pricing, interest rates when they were on the rise, uncertainty about the economy. And now that's all coming back. The pipelines have been very strong, but the whole industry is picking up. So deals are getting done. In fact, this quarter just reported we had a record fee, over $40 million fee just on one deal, which is big for us, and a couple of others up there too. So we're seeing deals activity pick up. The pipeline's been there. A lot of private equity firms especially have had cash waiting to put it to work, but people weren't selling. But we're seeing that activity way, way up, and I think across the industry. And I believe it'll continue to be good as financing's opened up, rates have dropped, and private equity has cash to deploy. So we expect this year to be a very strong year.
There's 4,500 or so banks in this country. I don't know what that number is heading toward. And there's obviously a lot of competition to be advising on these deals. And the shares of yourself, your rivals like Stifel and Piper, I mean, they're up 50, 60, 70% over the past year. So there are really high expectations, even if these deals are not, the big jazzy, mega cap deals. It sounds like what we should expect is a lot more on the small to medium size, almost the kind of things that sometimes don't make a lot of headlines beyond the regional papers.
Yeah, it wasn't too long ago that companies this size would have gone public. But the cost of being public and the simplicity of private equity has let very large companies stay private for a long, long time with private equity backing. And you're seeing those holds are usually, 3 to 7 years, maybe 5 on average. And with deal activity slowing down, those private equity firms, because they're in funds, need to turn over the cash because the investors want the cash to reinvest. So that's pushing, I think, a lot of the activity. And if you look at the economy, the outlook of CEOs is up this year, much more positive than it's been. And in our investor survey, 2/3 of our investors feel good about the economy, which is up, from just months ago. So there's optimism, at least over the short to midterm. And I think that's going to drive that deal activity.
You've been at the helm of 14 years or so, which kind of spans the post-financial crisis period, through the kind of lost decade that we had through the first Trump administration, now the second one, COVID, the massive inflation we haven't experienced in a long time. How would you describe the fundamentals of the U.S. economy? What has you excited? What are you more worried about?
Well, I think the steadiness in rates, financing, the financial system for all the things you hear or read about regulation is extremely well capitalized and operating very, very well. So those are strengths. I think the thing that people worry about most is just the debt, that we're accumulating through the deficits, and at what point will that be a drag on the economy. But I think for right now, people see pro-business, a strong economy, capital available, financing available. So certainly for the short to midterm, I think the economy will do well. And it's always hard to have a recession if people are working. And the unemployment rate, I think anyone that wants a job can find a job. It might be a little harder than it was 2 years ago, but there are plenty of jobs out there.
Well, I hope you're right about all of that. And I thought it was very interesting what you said about companies, that would have gone public now kind of pursuing something different. Paul, really appreciate you joining us. It's good to see you.
Thank you, Kelly. Good to be here.
Paul Riley with Raymond James.